Hi, we are Group 8, and for our capstone project, we created a trading algorithm. My name is Vansha Verma, and I created this project along with Kanak Borad, Andrew Lau, and Indy Go. Professor Trappy served as our advisor. While creating this project, our aim was to create an automatic trading algorithm that buys and sells stocks for the user. Before we get into the algorithm, we wanted to tell you why we built this application. This algorithm is meant for day traders. A day trader is someone who holds a stock anywhere from minutes to months. However, on the other hand, an investor would be someone who holds a stock for a long period of time, usually over a year. Most day traders end up losing money. A study done in 2013 by the Sao Paulo School of Economics tracked day traders in Brazil who traded in Brazilian equity futures markets for at least 300 days. The study showed that 97% of them lost money, and only 0.4% earned more than a bank teller. Only the top individuals who participated in the study earned more than $310 per day. Another study shows that after 10 years, 85% of large cap funds underperform the S&P. This only gets worse as time goes on. After 15 years, 92% of them are trailing behind the index. For day traders, it is estimated that 90% of people lose their money. While we hope our application can help people make money by making investments in the market, we want to disclose that we do not recommend that anyone use this application and risk money that they are not comfortable losing. Although it is statistically unlikely to make a profit, constant fluctuations in the stock prices allow for potential returns. Day traders make money off of volatility, which means making a profit is still possible in market downturns.
There are many benefits to using this program. Firstly, everything is done automatically. This means the calculations are performed faster and correctly, which enables the user to buy and sell stocks much easier and faster than before. Secondly, emotional factors are eliminated. This is because there is a consistent trading strategy compared to random guessing. As trading is now based on market indicators with adjusted parameters to fit into a day trading strategy. This will overall increase the potential of making profit.
In our initial attempt at the algorithm, we tested our calculations of the moving averages and RSI indicators and used only one stock, the SPY. Moving averages aid in determining if an asset price will continue in motion or reverse. When the price is above the moving average line, it is considered to be an uptrend or bullish, and when it is below, then it is a downtrend or bearish market. The breaking of a moving average line indicates a trend reversal. So if the price breaks above the line, you would buy, and if it breaks below, then you would sell. A moving average crossover is when two moving averages with different periods reflecting a short-term and a long-term trend in price are compared. If a shorter-term moving average crosses above a longer-term moving average, this indicates a bullish trend, so you would buy at this point. If it crossed below, then you would sell. We used a simple moving average which adds the last closing prices in X days and divides it by X days. This calculation gives equal weight to each day. A downside of this is that the SMA responds slower to rapid price changes, hence we also used an exponential moving average. EMAs give more weight to recent periods and thus it reacts faster to price action. The relative strength index is intended to chart the current and historical strength or weakness of a stock or market based on the closing price of a recent trading period. The index is from 0 to 100. If the RSI equals to 50, then it is a fair value. If it is greater than 70, it is considered overbought and the price may come down, so you would sell. If it is less than 30, it is considered oversold and prices may come up, so you would buy. Using these indicators, we set conditions to buy and sell in our algorithm. One of the issues we ran across was there were several periods of time where the algorithm didn't buy or sell, and it just wasn't executing enough trades in general. This was due to our narrow stock universe being only one stock and restrictive conditions for when to buy or sell. In the graph, the blue line indicates the total returns, which is the actual returns generated by the algorithm's trades. In the end, the common returns line in gray and the specific returns line in red will be calculated. Common returns is how much of the total returns that is attributed to the common risk factors as modeled by Quantopian. And the specific returns is the part of the returns that is generated purely because of the created algorithm. In our second algorithm, we added a stock universe of 1,500 US stocks, and then we filtered these stocks based on price to earning, earnings per share, and dividend. The PE ratio is the ratio of a company's stock price to the company's earnings per share. The ratio is used to find if the company is over or undervalued. The EPS is calculated as a company's profit divided by the outstanding shares of its common stock. The resulting number serves as an indicator of a company's profitability. The dividend is the distribution of a portion of the company's earnings paid to a class of its shareholders, which indicates a proportional increase or decrease in a company's stock price. To the algorithm, we also added leverage, which essentially uses borrowed money, a stop loss so that it sells at a certain price, and we made sure that the number of shares bought were aimed to be a certain percentage of the portfolio. A reoccurring problem from last time was that there were extended periods of time where it did not buy or sell. However, this problem occurred more frequently in times of recession. The algorithm would also end up crashing, which is why we are unable to show this. However, during times of steady growth, this algorithm did pretty well.
So before we get into the results of our final algorithm, we're going to go over some of the changes we made. And one of the things we added was a trailing stop loss, which is much like a regular stop loss, except a trailing stop loss moves up with the price. So in this example, the trailing stop loss is $500 from the entry. So as the stock price goes up, the trailing stop loss will go up with it. So it'll trail the most recent high by $500. And once the stock price goes down and hits the trailing stop loss, the algorithm will automatically sell it. In our algorithm, however, we did a trailing stop loss of 5% from the most recent high. We also made some changes to the pipeline filter. So we removed the PE ratio filter as we found that to be too restrictive. But we wanted to make sure the stocks we were buying and selling were moving in a positive trend. So we add the condition where the simple moving average of the 14-day period had to be greater than the simple moving average of the 50-day period. Or in this graph, the red line has to be greater than the blue line. We also added some extra buy and sell conditions. We added a MACD buy and sell signal. So in this graph, the red line is the MACD line, which is calculated by doing the exponential moving average of the 12-minute period minus the exponential moving average of the 26-minute period. The green line is the signal line, which is the exponential moving average of the 9-minute period of the MACD line. So when the MACD line or the red line crosses the green line, which is the signal line, that is a buy signal. And when the red line goes below the green line, that is a sell signal. So the buy here and sell here corresponds to here and here. We also added another buy and sell condition based on the standard deviations. So the blue line here represents 1.8 standard deviations below the average. And the upper blue line represents 1.8 standard deviations above the average price based on 20 minutes. So if it goes below this blue line, it will buy, and if it goes above this blue line, it will sell. And we can see that happens a couple times throughout.
In conclusion, we learned it is not easy for day trading to make profit. However, because algorithms are faster than human calculations, the potential of making profit is far greater. We can also conclude that the technical indications can be beneficial for determining when to buy and sell stocks, as these indications makes it easier and faster to complete the process. There are also many more features we would like to add to our algorithm. One such is the ability to determine which option contracts to buy, as option contracts has a higher risk in comparison to stocks. Another method we would like to add is the ability for the algorithm to adjust and relearn based on current constraints. One such constraint is the recent COVID-19 pandemic, which has crashed the stock market.